Hello and welcome to another episode of the Investor Financing Podcast. And on today's show, we're going to talk about a topic that is very important, but we never talk about, and that's insurance for your properties. And we've got a very special guest, Jeremy Goodrich. He is the owner and founder of Shine Insurance Agency, and he's been in business for many, many years. He is a commercial real estate insurance advisor, an LP investor, and a podcast host. Welcome to the show.
Beau, it's so nice to be with you today. I love talking about insurance. Hopefully we can make it interesting, dynamic, and tell some stories that help investors to really understand the tiny role that this important thing plays.
That's right. So I want to kind of dive in. Let's just say John Smith, we're going to use John Smith, has a property, let's call it a 100-unit multifamily property under contract, and it's currently 70% occupied. They're doing some CapEx or some renovations to the property. Where do you start with kind of sizing up the right insurance policy for something that's got moving parts? It's just some renovations that are going to be going on and so forth, because it's not fully occupied. They're going to be doing some work. What's your intake look like from that investor so you can get them the best terms possible on their insurance policy?
I think it's a great question. So the way we start with everybody is we have an online ballpark at shineinsurance.com/ballpark, which just gives you a general number based off of 9 yes or no questions. And if you answer yes to all of them, then you get the ballpark right away. The example you gave, you probably wouldn't be. So one of the questions is at least 80% occupied. You said it was 70% occupied. So the answer to that would be no. It sounds like there might be some other things going on with that property. And in that case, we're going to personally engage with you and learn more about the property. So no matter what insurance advisor your listeners are going to, I think it's important, especially when you have those heavy lifts. If you're doing some serious value add, if you've got occupancy under 80%, if your property is built more than 40 years ago, and especially in the 70s is a build date that there's lots of opportunity with right now because they're out there. But it's also a tough insurance time because they used aluminum wiring. There were some breaker boxes that turned out to cause fires instead of avoid them. So if you have elements of that, my best advice to your listener is simply to engage your insurance advisor in the conversation. Because while I can throw out a general number on something that checks yes to all 9 of my questions on the ballpark, when there are no's, it's much harder to get you an exact number. Now, someone who does this all the time can get you a number pretty quickly. I'm working on a property right now that's on the Ohio River in Madison, Indiana, built in the 70s, aluminum wiring, not in a flood zone. I'm not exactly sure why it's not, because it's directly next to the river. But flood insurance is certainly something they want to navigate. That's a client that I've had for years, and I'm taking a few weeks to get them a number instead of what I usually do, which is they text me and I text them back a number, because it's just a market that I want to understand better. So my advice for that investor, John, I think you said his name was, is to engage your insurance advisor early before you have it under contract. If you've got it under contract, you definitely want to talk with that insurance advisor, because if you're thinking $300 a door for the insurance line on your pro forma and it's $800, depending on how many doors that is, you gave a 100-door example, that's a $40,000 difference. So, you want to understand what's really going on there.
That's really important. So what can we do as investors to prepare for our conversation? What do we want to kind of jot down? Like, obviously wiring, what kind of heating, what kind of roofing? I think we take it for granted. I was just buying a couple. What did I just buy? I just bought a duplex. Mm-hmm. And I wasn't used to the components they use. Like in one of the units, it was oil heating. And I'm like, oh, I got to fill the oil tank. I don't even know that, right? Like I'm buying properties I don't even understand because I'm used to the West Coast where I live. Mm-hmm. So as you're doing this stuff, it's important to make sure you're giving the right what's included in these properties, right? Because if you don't and you get a policy and then all of a sudden there's a problem with that component and it's not specified in the insurance, you're probably not going to get paid your insurance claim. I'm taking it. I would imagine that happens oftentimes in the smaller type of stuff where people aren't really spending the time to tell you exactly what's in the property.
Yeah. Example here. So property owner, not my client, came to me after this situation and told me the story, but had a schedule of single family homes, was using the BRRRR method, picking them up, renovating them. and then getting them occupied before refinancing them, and had, I think, 15, 20 units that had been done that way. Picked up a new property, called the insurance advisor, said, hey, add it to the schedule. And the insurance advisor added it to the schedule. Under renovation, totally vacant, someone's drilling through the wall. And this happens more often than you think, where a drill bit causes friction. Friction causes a smolder. Smolder causes a fire, but oftentimes not till 20 or 30 minutes later. Well, when the smolder started to cause the fire, everybody was at lunch. So vacant house, everybody's at lunch. They come back, fire department's there, nothing left of the house. Okay, well, that's what we have insurance for, right? That's why we have insurance. Glad we had insurance. Called the insurance advisor. Well, the insurance advisor added it to the schedule, just like everything else, as an annual tenant occupied property. They did not add it as what it actually was, which was a vacant property, had been vacant for a long time. Claim didn't pay out. Total denial of a total loss claim. In this scenario, he had $90,000 into it. You know, he was someone who had a schedule that could back it up, had capital set aside. Wasn't the end of his investing journey, but certainly from a lot of your listeners, you hear that story, you're like, well, that would be the end for me. You know, that kind of thing gets back to your question, which is, what do you need to provide to your insurance provider? And I think the answer is as much information as possible. You don't want to say add it to the schedule. If you say add it to the schedule and your insurance advisor says, got it, done, you said one piece of information and they said it's taken care of, I would be concerned about that insurance advisor. Not that you need to answer a billion questions. What we try and do is balance between the two, right? I don't want to hit you with 1,000 questions and ask you every single thing. I'm going to go online and find everything I can find online and not ask you for that. But there are some things I need to know from you: how old the roof is, how old the HVAC systems are, what the occupancy of the property is going to be from the jump. Those are 3 pieces of information I simply don't have without asking you for them. So I think as an investor, what you have to do is make sure you're communicating clearly with an insurance advisor that you trust to actually be a part of your service team. Someone you trust, like your property managers, someone you trust, like your lawyers or your accountants or other people who are on the team. As a real estate investor, especially a commercial real estate investor, you have to have a team. I'm sure your listeners have heard that on your show over and over and over again. Team relationships are the most important part. If you're thinking about the insurance advisor on your team as a commodity provider, someone who's going to shoot you a quote just like the 5 other people you asked for, then you're going to get the cheapest one and move forward. You're doing it wrong. You have to think about your advisor as a member of your service team.
That makes sense. Now you just do commercial property, so you're not going to do, like, you wouldn't finance this guy's portfolio of single family homes. I mean, not finance, insure.
No, I don't do portfolios of single family homes. I do commercial real estate across the nation. And that is multifamily, office, retail, industrial, self-storage. So things that are 5 doors or more are in the loan world, in the lending world, and in the insurance world considered commercial. And that's where we start.
What about assisted living facilities? Is that something
Sure. I'm doing a couple right now. And there's just, a few more questions. So that gets to the heart of, if you have other risks like student housing or assistant living or, heavily subsidized housing inside your property, your insurance advisor should be capable of handling that. They're just going to ask you a few more questions, If it's assisted living, they're going to want to know more about exactly how that's set up. They probably have a supplemental application that the insurance company has asked them to fill out for places that have assisted living services. And they're going to ask you some questions about how that service is provided inside your building.
What about insurance for construction if it's a ground up construction on a commercial property?
Great. Yeah. So the insurance for construction is called builder's risk coverage. There's a little bit more to it than just that, but to drill it down, it's really builder's risk coverage, which is coverage from breaking ground to fully completed vacant property. As soon as you start putting tenants in and leasing up, now you need to shift your insurance policy from a builder's risk policy to a standard commercial policy that can handle that property with its occupancy. Builder's risk is great because it covers not only the building itself as it is built. When you get closer to the end, you've obviously got a lot more value in that building than you did at the beginning, but it also covers the materials that are being brought to the property, that are sitting on the property. Generally, if you have a good insurance advisor, they should set it up so you have some contingent workers' comp, some general liability coverage that helps protect your entity if anything bad happens on the property. Obviously, that's going to happen between you and the builders as well. And those contracts you have with the builders is super important. But yeah, ground up is something that we do all the time.
So on a builder's risk policy, the policy, does it cover the general contractor too?
Depends on how you set up there's two things that it depends on. One is how you set up the contract with your general contractor, and two, how you set up the insurance policy. The two should be aligned with each other. An insurance policy should always follow a contract. For example, if a tenant has something happen inside an existing multifamily property, the contract that you have with that tenant suddenly became really, really important because it's the foundation under which everything happens after that. The same thing goes between a builder and a property owner when you're doing ground up. It really depends. A lot of builders want to bring the insurance in under their umbrella or their policy. It depends on how you do ownership as well. Sometimes the builder will essentially want to own the building with you as an investor, or depending how you have it set up, until it's completed. If you are the owner of the building, it's different than if the builder is the owner of the building. That wasn't a very clear answer for you, Beau, because it really depends on the relationship between you and the builder and how you've built that relationship, what the builder wants, what you want, and advice from your lawyers and advice from your insurance advisors.
Well, I think that's important just to point out, because we don't think about this as investors, like, okay, I'm just going to get insurance. But really, you should take the time to just figure out, well, what if this happens and this happens? And read through your policies and things, because I had a tree that fell through one of my roofs in my Indiana properties. And luckily, it was covered, but I never really read through, and you just got to be aware of all this stuff. And I think nobody ever talks about it, so it's good that you're out here with a podcast and you talk about it and you're educating people that. You always want to just know what the what ifs, the downside risks, the deductible options. Now, here's a question for you. When I finance a property, there's a lender, and the lender wants to be named as an additional on the mortgage clause.
Yep, sure.
So in case of a default in case of like something happened to the property, what is the lender being named on the as an additional insured? Does that mean they're protected just like I am because they're on the mortgage clause?
Yeah, I want to answer that question, but can I take a step back to that last conversation we were having and just close that out real quickly?
Sure.
So one of the things on my podcast, it's called Managing Commercial Real Estate Risk. And we talk all about how to take bigger risks and at the same time, like you just said, limit the downside. And I think it's a key thought process when we're thinking about, I just get a policy, I get some insurance, and then when the tree falls on my house, I'm like, oh crap, I know nothing about this. I think really understanding all the elements of the risks that you take as a real estate investor, and then learning how to manage them is really important. For one, because it'll increase your profit margins exponentially. When you start to think about risk in that way, it really starts to help you make intelligent decisions about every element. But also it just helps with things like talking to your insurance advisor when you're coming from the perspective of, okay, I've bought this $1 million property. I've got investors on board with me that are trusting me with their $100,000, $200,000. And I want to make sure that all of my boxes are checked when it comes to risk. And one of those is risk of something happening to the property. And that is where insurance comes in. So just kind of a mindset thing for investors, really thinking about the decisions you make from the perspective of managing risk. You asked the lender question, which is a really important one. And I think for your listeners, the most important part of this is that when that tree falls through the roof, most of the time, it depends on the size of the check, but most of the time, the check that comes from the insurance company is going to be written to the mortgage lender and you. The check is not going to be just written to you. especially if it's a large claim. That comes back to what does it mean to have a lender on your insurance policy? Well, it means that you don't get the money right away when something happens. It goes to your lender, who has probably the largest financial interest in your property, depending on what your lending situation is. And your lender likely is going to put it in an escrow account and then pay out over the course of the claim process as it makes sense to do so. So a lot of times an investor or a homeowner thinks, well, I just had a total loss. Well, that's a bad example. I just had a $50,000, damage thing happen to my house. The insurance company is going to write me a check for $50,000, and that's just not the case. That's the way that the mortgage lender is protecting themselves, so that you don't have a fire in your property and then just be like, hey, forget it, I'm going to leave it alone.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. So if I was doing a value add renovation project on, let's just call it a multifamily property, and it was a smaller multifamily, I didn't syndicate the deal. I was the only sponsor. I have senior debt from, a bridge lender, and they're going to, give me the renovation costs. And then I also borrowed a second lien position from just a private individual. That person too is a second lien holder, but they should also be named as an additional insured, probably for their protection as well.
100%. Yeah. So and you just got into the second reason to be added as an additional insured. And in nerdy insurance terms, probably lending as well, an additional interest is what I just described. An additional insured means you also have liability protection if someone sues the owners, because you hire a personal injury attorney. They're going to sue the owner of the building. They're going to sue the next door neighbor. They're going to sue the lady that was walking by when the bad thing happened. They're going to sue the mortgage company, and the mortgage company is where the money is. So they're probably going to sue, and they're going to sue that second mortgage holder. Anyone who has any interest, they're going to probably file a lawsuit against. Now, they probably won't win most of those. Most of those other interests will fall off. But if you're not an additional insured, if that bridge lender, if that individual is not an additional insured, then they would not have any protection from the policy. Now, a quick caveat is if you're an LP investor, you really don't have any exposure in the way that the example we just gave was. I'm an LP investor in multiple deals. I am not named as an additional insured on that investment property. It doesn't make sense because of how the structure is built.
That's interesting. Okay, very good clarity on that. Now, what are a couple things that you would point out to somebody listening right now, what they should be looking for in an insurance policy? Not always the lowest deductible. Like what are kind of the framework of, like, if you were giving advice to somebody that was making a big investment and you really love this person a lot, or it was just one of your clients, and you said, this is why I would probably do this type of policy versus this type of policy. Can you kind of walk us through like the different kind of scenarios and options that they might see and get those choices for?
Absolutely. And I look at a lot of policies. So one of the things I do for folks oftentimes is just say, send me over what you have right now. I'm happy to look at it and tell you what I see. So I look at insurance policies in the exact same way you're asking me to right now, all the time. And I think here are some of the things. If you're listening right now and you're like, I'm not sure if my insurance is any good, you can listen to this section, maybe pause for a second and go get your insurance policy. And I'll just give you some quick things to really see if you have quality coverage or not. The first thing is a replacement cost amount that is somewhere too close to how much it would actually cost to replace the building. There's some argument about that. Well, what if I only have a half loss? I only need $50,000 of coverage on my $300,000 house because I'm just hoping that I don't have more than a $50,000 loss. Well, that's true in some scenarios, but the first thing really is to make sure you have that replacement cost correct, because there's something also called a co-insurance clause, which basically penalizes you for underinsuring. And so that's the other thing you want to look for. If you have 100% co-insurance, that is very bad. Beau, if you'd like me to go in the weeds on any of this, I'm happy to, but I'm just going to go down the list right now rather than getting too far in the weeds. So making sure you actually have enough coverage for what it would cost to replace your building. Making sure you do not have a 100% co-insurance clause. You want to see co-insurance waived, 80% co-insurance, no co-insurance mentioned. That's another thing. A big one is to look and see if there is ACV coverage anywhere on your policy. That is bad. And here's why. Let's say you have a roof and that roof is going to cost $15,000 to replace. You have a $1,000 deductible, so $14,000 should be available to you. But you have ACV coverage. The insurance adjuster is going to come out and say, well, we're going to depreciate for the age of the roof. And this roof is 20 years old. So even though it's going to cost $14,000 to replace this roof, we're going to pay out about $5,000 because it's 20 years old. We're depreciating for the age of the roof. ACV coverage means every claim payout is going to depreciate for the age of whatever the thing is that's damaged. It reduces your claim by a ton. And it's what a lot of insurance advisors, insurance companies do to reduce the cost of the premium for an insurance policy. So when you're buying a cheap policy, it's very likely that you're seeing ACV in there somewhere, and the insurance company knows, although they're not pointing it out, that the claim payout is going to be much lower. So those top three things are what I would look at. One is the replacement cost, the right amount to replace your building, or at least close, $100 a square foot at least. In most multifamily scenarios, probably it's more like 140 or 150 in our current scenario, but being somewhere in there, having a lower co-insurance clause or no co-insurance clause, and trying to avoid ACV coverage.
Okay, now let me ask you another question. Let's just say, I'm only going to speak to what happened on my house in Indiana. A tree fell down. I made a claim. I got paid for the claim. I paid my deductible. Is there like a national database that these insurance carriers, like if I obviously it was something out of my control, but do my rates go up because I filed the claim typically?
Probably. Yeah. I mean, so a couple levels here. One is if you're a listener, or if your property, I believe, was less than 4 doors, then it's probably on a personal insurance policy. Even if it's in the name of an LLC, it would be on like a dwelling fire policy. And in that case, it's going to go in the same database as an auto claim would, or another kind of homeowner's claim, where it can be pulled by anyone who gives you a quote. So yes, it's absolutely going to be something that's in there and will likely affect future premium. I mean, I don't love that insurance claims end up increasing your insurance rates. But they do, there's no real way around that. And so especially for less than 4 doors or less, it's absolutely going to be there every time you quote. For commercial real estate, 5 doors or more, oftentimes when you're getting a quote for an insurance policy, your insurance advisor is going to ask for loss runs. You're going to say, hey, could you ask your current insurance agent or the insurance agent for the seller, if you're considering buying a property, to send us loss runs? Now, seasoned investors they usually have loss runs when people will reach out to me over email and say, hey, I'm buying a new property. Here's the offering memorandum. Here's the T12s. Here's the loss runs. Let me know what you got. And, that's a really great place to set as a foundation. But loss runs are interesting because the property will hold the penalty for claims that happened even before you purchased it. So I'm doing one in South Texas right now, Harris County, right on the coast, senior living property. And the previous owner had a $12 million claim. This property is already on the coast. I mean, it's already hard to insure anyway. You throw a $10 million claim on, and now it is almost uninsurable. We're going to be able to pull it off and it's going to work. But we're talking about $1,500 to $1,700 a door in insurance costs. understanding that from the start is really important for the investor, so that investor can, say, all right, well, does that kill the deal? I don't like to kill deals, but if I'm going to kill a deal by telling you the truth about the insurance cost associated with a given property, I want to do it really early in your journey, as opposed to really deep in due diligence. I don't want you to lose your hard money. I want you to really understand these things right from the beginning. And so that's just part of what we're looking at.
That's a huge nugget. That's loss run reports. That's very important. Like, now that I see it, because you might, I own another building in the area and I'm paying, X amount per year for a premium. Well, maybe they didn't have this huge claim that's going to run with the property. And I never thought about that. So that's hugely eye-opening. So when you're doing your due diligence in the beginning, when you get an LOI on a property, this is probably when you want to do it before you spend too much money doing inspections and things. You're going to because that could throw a deal. I mean, it's probably happened more than once, right?
100%. And if you're investing coastal, I mean, it is just such an interesting market right now. We have insurance companies leaving these coastal markets in Texas the way they were leaving the markets in Florida in 2008 and 2009, after multiple hurricanes really knocked on Florida's door and came through, and lots of losses with that big power outage and the freeze. I don't know what all the names are for it in Texas, though. We're really seeing the repercussions of that on the insurance side. So if you're investing coastal, it's just so important that you get your insurance advisor on the horn and in the mix super early in the process. That's
awesome. Well, I think we covered a lot today. Considering it's insurance, and insurance isn't sexy. But there's a lot of stories. There's a lot of stories.
No,
I know. I think this is like super important. And now, like, my eyes are wide open to things that I never even thought about. And I think this is like very important for you to do what you do and give guidance to people, because this can throw deals way out of whack when they're running their numbers. And even though that the other person's policy that they're paying, their premiums might be super low, but it could change drastically when you get a new policy, because they might have an existing relationship and other accounts, other insurance policies with that provider. So,
or they're a $10,000 investor that has a just entirely different structure of their insurance. And obviously, when you have $10,000, you get a little bit better pricing than someone who's just purchasing their first 40-door property.
Well, any closing kind of like comments that we didn't touch on that you want to make people aware of in the insurance industry, and then also where people can find your podcast and where they can find you?
Yeah, no, I really think that thinking about insurance and a lot of the decisions you make from the two-step process of understanding risk and then managing risk is a really key thing to do. And then I hope that folks will head over to shineinsurance.com/ballpark and start using that every single time you're penciling a deal. It's super easy. It's 9 yes or no questions. It sends you a number right away. Make sure you don't listen to a guru about what your insurance price should be for a given property, or don't just take the seller's, T12s, or T12s are better than like the OM, but don't, make sure that you have some numbers that are solid for this particular piece. Head over to shineinsurance.com/ballpark to do that. And obviously you can find me there as well.
Awesome. Well, appreciate your time. This was definitely eye-widening for me. And I know the people out there got some value out of here, and they're going to probably start actually thinking about insurance. Like, instead of just buying a policy, they're going to actually kind of look and compare. And you gave us some tips. I'm going to try to go back in the show notes and put those bullet points that you said, because that was very good. And I want to keep that as a reference for myself as well. So anyways, thanks for joining us on another show. Please like and subscribe, and we'll see you on the next episode. And thank you.